Hello everyone. This video is here to explain you three very basic but important concepts. Revenue expenditure, capital expenditure, and deferred revenue expenditure. So we'll understand the meaning of these three and then the differences between these three. It will be very short but simple, and at the end I will give you some really good examples which will help you to understand the topic even better. So let's start with it. So I have this table here where I will try to explain you the entire concept based on these 5 points. The first point, purpose. Revenue expenditure. This is done with the primary objective of generating revenue as the name suggests. The second one, capital expenditure. This is done to acquire fixed assets, and the sole purpose will be to increase the earning capacity of the business based on that fixed asset. Deferred revenue expenditure. As the name suggests, it's again a revenue expenditure, but the impact of this revenue expenditure can be availed for multiple accounting periods. Usually, the amount of such expenditure is very high, so it will have to be charged to the profit and loss for multiple periods. It can be between 2 to 3 years. The second point, tenure. Revenue expenditure is only for the particular accounting period, so the entire amount is charged to P&L directly. Capital expenditure, as it's a fixed asset, so it will be depreciated for the life of the fixed asset. Deferred revenue expenditure, as I already said, this expenditure will be charged to your P&L based on the impact that it creates for your business. So it can be 2, 3 or 5 years based on how long the impact is carried. Impact for revenue expenditure, it is done to run or maintain your day-to-day businesses. So for example, your cost of material purchase, your labor expenses, your salaries. So you have to pay that so that your business runs. Capital expenditure, as I've already told you, it is done to increase the earning capacity of the business. So you buy an asset, a fixed asset, it will ultimately help to improve your business. It will ultimately help to increase the earning capacity of the business. Deferred revenue expenditure. This is again done to maintain your earning capacity of the business, but the only difference here is the impact of this can be taken for more than one accounting period. Next point, conversion into cash. Revenue expenditure can't be converted into cash. So you are paying salaries to your employees. You cannot just convert that salary and then in return take money out of it. So it can't be converted. Capital expenditure, it can be definitely converted into cash because ultimately you are buying a fixed asset. If you sell that in the market, you will get the residual value or whatever net value it has, you can get in return. So it can be converted. Deferred revenue expenditure, this can also not be converted, primarily because it is an expense that you have already incurred. It's just that you are not charging that entire expense to your P&L in that particular year. Write off. Revenue expenditure is written off entirely in the current accounting period in the PL because it is for the current period. Capital expenditure, it is written off in the form of depreciation, which is based on the method of depreciation that you choose and is charged to your P&L over the life of the asset. Deferred revenue expenditure, this is written off over the period for which the benefit of that expenditure that you're making can be availed. I hope the concept is now clear for you all. You can take a screenshot of this page so that you can have this handy whenever you require it. Now the next part is we have some practical examples and we will try to understand the scenarios and then see how they can be linked with these three types of expenditure classification.
And lastly, we have the examples here. It will give you more clarity about the concept. Let's start with the first one. Purchase of raw materials. The raw material is an operational expense for any business, so it can never be capital expenditure. Moreover, it is not something which the impact of which can be taken for more than 1 year. So it is not even deferred revenue expenditure. So the one left here is revenue expenditure. So purchase of raw material will always be revenue expenditure. Second one here is purchase of furniture by a software company. Software company makes software and it does not make or buys furniture as an operational expense. So it's an investment for the company. Hence, it's a capital expenditure. Third one. Third one. Huge advertisement and promotion expenditure with a contract for 3 years. So the expense is unusually large, firstly. Secondly, it's a revenue expenditure as it is made to run or to maintain the earning capacity of the business. Thirdly, it is incurred for a contract of 3 years. Hence, this is the deferred revenue expenditure. Next example is depreciation expense. So depreciation expense is again something which is actually the written off or the depreciated value of the fixed asset that the company has purchased, and it has to be allocated to the profit and loss account over the life of the asset. So it is a revenue expenditure. Fifth one, salary is paid by a software company. Again, we are taking an example of software company. Here also salary being one of the major expense of a software company has to be a revenue expenditure because it is incurred to earn your revenue. Purchase of second-hand machinery by a car manufacturing company. So now the example is for a car manufacturing company where it actually is buying a second-hand machinery. So it's a second-hand or first-hand, it does not matter. It is buying a fixed asset, so it's definitely a capital expenditure. The next one is expenditure on relocation to reduce logistical cost. So the cost is to reduce your logistical cost, and it is primarily for the purpose of relocation. So this is a revenue expenditure, but there is a catch. Since this expenditure is unusually large, as it is related to relocation or relocating a business from one place to another will attract a lot of cost. Hence, we'll have to classify this as deferred revenue expenditure. And the last example here is again for a software company. Let's say it is hiring some employees. They all are freshers, and the software company has to train them so that the fresher employees can start working for it. So these training expenses are revenue expenditure for the company.
If you have any questions or queries, or you need any explanation on a specific scenario for such expenses, do let me know in the comment box and I'll be happy to answer you. Thank you.